Hi, this is Claus Vogt for Money and Markets TV. As I've said before, I expect the current cyclical bull market to come to an end very soon and give way to a vicious bear market. Today, I want to give you my top 6 reasons why. First, the US stock market is way overvalued. This is not just my opinion. It's the conclusion of several fundamental valuation measures, including price to earnings ratio, dividend yields, and Tobin's Q ratio. Then last week, the famous value investor Jeremy Grantham said that according to his methodology, the S&P 500 is 45% overvalued. And since bear markets tend to drag stocks below their fair value, the broad market could have a long way to fall. Second, sentiment indicators are about as lopsided as they can get. For instance, the Investors Intelligent Advisors Sentiment Index showed more than 3 bulls for every bear during 4 of the past 6 weeks, a very unusual stretch of bullish sentiment. Plus, the Investment Company Institute's latest figures show that the cash level of investment funds hit a record low of 3.4% in March. Never before have fund managers been more heavily invested in stocks. That's a very bad sign for the market. Third, the cyclical bull market is running out of time. Historically, these types of bull markets last for about 2 years. This one is at 27 months and counting. Combine that with severe overvaluation and irrational exuberance, and you have got every reason to be very cautious going forward. Fourth, QE2 will soon be history. The Federal Reserve's second round of quantitative easing last year stopped the economy and the stock market from going into a double-dip recession. The asset buying program did little to fix the underlying economic problems, but it did prop up the stock market, boosting the S&P 500 12% above its April 2010 high. But come the end of June, QE2 will be over, depriving the market of its support, and QE3 seems to be out of the question, at least for now. Fifth, commodities and the dollar have just experienced strong reversals. Over the past couple of weeks, silver prices have fallen down from $50 an ounce all the way to $33. Crude oil, copper, and timber, all leading economic indicators, have taken a tumble as well. Meanwhile, the dollar has turned higher while the euro is dropping. That's a bad sign for risk assets like stocks. And sixth, emerging markets are looking weak. The BRIC countries, Brazil, Russia, India, and China, are lagging the S&P 500. And the stock markets in Australia, France, Hong Kong, the UK, Mexico, Switzerland, and Japan have all been losing ground recently as well. In addition, most emerging market central banks have begun to tighten their monetary policies. Last week, China raised banks' reserve requirements for the 5th time this year. Tighter monetary policy almost always leads to an economic slowdown, if not a full-blown recession. This recent performance is a bad sign for the US market because it tends to follow emerging stock markets. They were the first to hit bottom during the last bear market, and now they may be leading the way into the next bear market. Therefore, this could be a good time to consider an inverse emerging markets ETF like the ProShares Short MSCI Emerging Markets, ticker symbol EUM. If you buy it at current levels between $30 and $31, I suggest putting a stop loss at just below $30. I'm Claus Vogt for Money and Markets TV. Thanks for watching.